Hello everyone, in this session I'm going to cover a topic buying versus selling options. Most of the new option traders always face the dilemma about should they buy an option or should they sell an option. They may be bullish or bearish on a stock, but then there are two ways to express the sentiment that you can do by either buying the option or by selling the option. So the $1,000,000 question is, should I buy the option or should I sell the option? In this webinar, I'm going to cover the details around buying versus selling, and hopefully you'll find it useful. So let's dive right into it. Let's do a quick recap of some basic concepts before we get into this session. So there are two building blocks of any option trading. The two basic building blocks are put option and a call option. Put option gives the buyer of a put option a right to put or to sell the underlying stock at the strike price on or before the expiration date. Whereas the call option gives the buyer of the option, i.e. the buyer of a call option, a right to call or to buy the underlying stock at the strike price on or before the expiration date. Keep these two basic concepts in mind, and then the rest of the things will become easier. All right. Now, using options, there are more than one ways to set up the trade. Means, if I'm bearish on a particular stock, there are two types of trades that can be done. Either you could buy or you can be long a put option. Means you are bearish, you think that the stock will go down and you want to protect your position. You could do that by being long or by buying a put option. So that, let's say in this example, if you buy a put option here, if the stock goes down, this is a profitable zone. Or the other way is to sell or to go short on a call option. This is also a bearish trade. Means if the stock is moving down, you make money, green area. Stock goes higher, you lose money. Okay. Similarly, if you're bullish on a stock, again, there are two ways to express that sentiment in options trading. One is you go short put, means you sell a put option. So if a stock goes higher, you make money. Stock goes lower, you lose money. Or the other way is you buy a call option, means you go long on a call option. Stock goes higher, you make money. Stock goes lower, you lose money. So for both bearish as well as bullish, there are two types of trades available. Either you can buy a put option or you can sell a call option for bearish trade. For a bullish trade, you can sell a put option or you can buy a call option. Now the $1,000,000 question is, should I buy the option or should I do the sell option trade? That's what we're going to address in this particular webinar. All right, let's move ahead. Let's look at the put option first. Now the stock is currently trading at $95 and the at the money strike is 95. Okay. So now if you are a put option buyer, in this case the stock is trading at 95. If you buy the put option, you start to make money if the stock goes low because it's a bearish trade. This is a long put bearish trade. So what happens if a stock goes down? Great, you make money. But if there's only a minor movement in the stock doesn't go down by a large amount, then you actually lose money. You don't want this scenario. See, when you are buying a put option at 95, you are paying a premium to get into this trade. So unless the stock goes lower than the amount of premium that you've already paid, it's not a profitable zone. If a stock stays between this, you are still losing money because of the initial premium that you paid. So any minor movement in a stock in the downward direction is not profitable. You need to make you need to have the stock make large movements. What if a stock goes higher? No, not a profitable zone because you bought a put option. Let's consider if you are selling a put option. Means you sell a put option when you are bullish. So if a stock goes lower, for example here, if a stock goes lower by a large amount, it's not a good scenario for you. If a stock makes a minor movement, means you sold a put option at 95 and let's say stock is at 93, it is still a profitable zone for you. Why? Because when you sold this put option, you collected some upfront premium. So that gives you the cushion or the buffer. So any minor movement in the stock, even in the opposite direction of your assumption, could still be profitable. And if the stock goes higher, which is what your assumption was because you were bullish when you did a short put, it is a profitable zone. So as you can see here, a put option buyer is losing in two scenarios, winning in one scenario. A put option seller is winning in two scenarios and losing only in one scenario. Now let's look at the call option and see how the buying and selling of call options works. Considering that the stock is $105 and we are looking at 105 at the money strike price. Premium collected is $5. So for an option seller, means a call option seller, someone would be call option seller if they are bearish on a trade and they will buy put or they can sell a call. So let's see, if somebody is selling a call at a strike price of 105, collecting a premium of $5, if a stock goes low, it is a profitable zone for them. If a stock makes minor movement, means stock makes a movement of less than $5, it is a profitable zone for them because when they sold a call option, they collected an upfront premium of $5. So that $5 gives a buffer. So as long as stock doesn't go higher than a $5, it's a profitable zone. If the stock goes higher than more than $5, this is not a desirable scenario because it's a loss making zone. Now let's look at a call option buyer who would have bought a call option at $105 and paid a premium of $5 to enter into this trade. Now, why would somebody buy a call option? Because they are bullish on a stock. Now somebody buying a call option, if a stock goes low, means this area, this is not a desirable zone. If a stock makes a minor movement, even in the direction of their assumption, it is still not a profitable zone because for the long call option buyer to make money, stock has to make a movement which is greater than $5 because they paid a premium of $5 to enter into this trade. So stock has to make a movement of more than $5 to be profitable. So minor movement less than $5, not a good scenario. If a stock goes much higher than the $5, yes, this is what a profitable zone for a call option buyer would be. So like we saw it in a put option case, even for the call option, 2 out of 3 scenarios prefer option sellers. Only in one scenario, option buyer is profitable. Okay. So just to summarize, option seller can win in 2 out of 3 scenarios of stock movement. Either the stock goes in the direction, or even if it is not in the direction of assumption but makes minor movement in the opposite direction, option sellers can still win. So in 2 out of 3 scenarios, option sellers wins. Now let's look into the other concept between buying and selling, and we're gonna analyze it from a concept of margin of error, right? If you are buying an option, you are immediately lose money if the stock does not cooperate. There is no room for error. For example, let's look at this. Now, this is a case of a long put, means you bought a put option. You were bearish on this particular stock, so that's why you bought a put option as an insurance. Now, this was the strike price at which you bought a put option. So, the moment stock goes in the opposite direction of where you wanted it to go, which means stock, instead of going low, if it becomes higher, you immediately start to lose money. This is all the loss zone for you. Even if the stock cooperates, it needs to make a big move before you start to make some money. Let's hop on over to the call side and see how that would fare. Now, if somebody had bought a call option, they would buy a call option only when they are bullish on a particular ticker. Now, this was a strike price of the call option. If the stock starts to go in the reverse direction, they immediately start to lose money. This is a loss zone. Even if the stock cooperates and start to move higher, they're not going to make any money until stock makes a movement which is more than the amount of premium that they have paid. So stock needs to make a big move to cover the initial premium or the initial debit. Now let's look into the case of selling an option. If a stock goes against you, what happens to the option seller? Now we are looking at a case of a short put. Short put means the trader is bullish on a stock. So the strike price is this. Because the initial premium was taken by the trader, the break-even point is this. So if the stock does not cooperate, the stock does not move in the bullish direction but starts to go in the lower direction, you still have a margin of error. As an option seller, they still have this much margin for error because of the initial credit that was taken as an option premium. But if the stock cooperates, here immediately they start to make money. This is all the profitable zone. Let's look at the call option. Somebody is selling a call or somebody going short on a call. Why would someone go short on a call? Because they are bearish on a stock. So now if a stock does not cooperate, instead of going in the bearish direction, stock starts to move higher in this direction. Still, this trade is making money until the stock makes a large move. So they have a margin of error, which is the initial premium taken. And if the stock cooperates, that is, if it starts to move lower because it was a bearish trade, immediately this trade is profitable. This is all the profitable zone. So now in both the cases, whether it's a bullish or a bearish trade, if a stock cooperates, this trade immediately gets into profit. If a stock does not cooperate, still there is a margin of error which is provided to option seller. Okay. So quickly to summarize, option selling can be profitable even if the stock moves in opposite direction of the trade assumption. Why? Because when you sell an option, there is a margin of error available, or there is a cushion available by the amount of initial premium that is taken in while selling an option. Third one, we'll look into the impact of time on the option seller or buyer. Let's look at some universal truth. First and the foremost, time will always move forward, right? The time machines that can take you back to 1800s only exist in science fiction movies, not in reality. This is a universal truth, that the time will always move forward. Other universal truth, options are decaying assets. They have an expiration date, they have an expiry date on which the value of option will become 0. So this graph shows you how the option value decreases over time. The rate at which the option value decreases changes, but the fact is that the value will decrease over time. So when it becomes 0 days to expiration, means the expiry date is here, the value of option becomes 0. Everything else remaining the same. Remember, time is one of the factors that impact option pricing. There are other factors also, but everything else remaining the same. Option buyers lose money just because of passage of time. And we all know that the time will pass. Option buyers bought something whose value decreases with time, whereas option sellers are on the reverse side. So the universal truth that the options value decreases helps option sellers. Okay. All right, let's move on to the next one and view the difference between the buying and selling from a probability of profit lens. So for an option selling, because of the initial credit received, because of the initial premium received, the probability of profit is more than 50%. For option buying strategies, the probability of profit is less than 50% because of the initial debit. If you are an option buyer, you are actually dug a hole. First you need to fill up the hole before you can talk about making money. So in the option selling, you already got money and all you need to do is to protect that money. Option buying, you have to first fill the hole, then you have to worry about making money. So to summarize, math favors option selling. It has higher probability of profit. Okay. Now let's look at another angle, which is volatility, and I'll go a little more detail into how volatility impact options. So stay with me. So volatility impact option pricing in a way that if it's a higher volatility, the option premiums are higher. If the volatility goes down, the option premium or the option prices goes down. Option sellers sell premium, means they are selling volatility, because the volatility is directly proportional to the option premium. So sellers selling option premium means they are selling volatility, and option buyer are reverse of option sellers. So they are buying option premium, so they are buying volatility. So if volatility goes down, it's not a good scenario for option buyer, but great scenario for option seller. Volatility goes higher, it's a great scenario for option buyer, but not a good scenario for option seller. Let's look at how the volatility is measured in US. So volatility of the broader US market is measured by volatility index called VIX. Now the VIX is a volatility measure of SPX, which is the S&P 500 index. This is the representative of the broader US market, is the top 500 companies being traded in US markets. So this is also known as fear index, VIX, because people measure fear in terms of the value of VIX. If the VIX is higher, means the traders are fearful of stock market, and you will generally see that if VIX go higher, the option pricing goes higher. If a VIX cools down, so does the option pricing. Okay. So bigger question is, does that fear always materialize? Right? If traders are expecting 5% drop in the market and they're ready to pay a premium to protect for 5% drop, does that drop is always more than 5% or 5%? Does the fear always materialize? So over long term, historically we have seen that the fear is overstated. So the premium paid out is more than the protection that it provides. In a nutshell, the volatility, in case when I say IV, means implied volatility, what the traders are implying about the volatility is overstated in long term. It is important to emphasize the word long term because it might happen that for one particular month, what traders were expecting for the stock actually moved much more than what their expectation was. But over a long term, over a decade, 15 years, the implied volatility is overstated than the actual movements. Okay. Let's see this particular chart. Now in this chart, we are looking at the difference between the implied volatility. This is the implied volatility, means what traders were expecting markets to. This is how much the market actually moved. So looking at the data of almost 14 years from 2004 all the way till 2017. If you notice, in almost all the years except 2008 when the financial meltdown happened, the realized volatility has always been less than the implied volatility or the implied movement. In 2004, the difference was almost 4.5%. In 2007, it was almost 2%. In 2015, it was almost 1.5%. In 2016, it was almost 4% or 4.5%, almost 4%. So over a long term, the realized volatility, that the amount of a fear that actually materialize, is lesser than the fears that was expected in the market. That means the option pricing is higher than the protection that it would be providing. Now we looked at VIX, which was S&P. Now let's look at how the Dow Jones index have done. So Dow Jones is a collection of 30 companies. Now the data is from 2002 all the way till 2016. Again, what you see in teal blue is the implied volatility. What you see, this one is a realized volatility. Again, barring the case of a financial meltdown, most of the time the realized volatility is less than implied volatility. So this again proves that not only in S&P 500 but even on Dow Jones index, the volatility has been overstated. Now because of the overstatement of implied volatility over this long period, it means that the option selling strategies should have been more profitable than option buying strategies. Is that the case? Let's cover that in next few slides. So let's also look at the empirical data and see, if the volatility is overstated, does that mean selling an option means you're selling a premium? Is that a profitable strategy? So let's look at the empirical data, and in this case we will compare either going long means look at the buying option strategy, or short means selling options on S&P 500 ETF from 2009 to 2018. I don't have to remind you that 2009 to 2018 has been the longest bullish run in US stock market. Okay. Now in this case we are looking at if somebody is bullish on US stock market from 2009 to 2018, good for them because that's what market did. But let's look at how the two ways to express bullish sentiments have performed. So there are two ways. If you are bullish on a stock, either you sell the put, means you go short put, or you buy a call, means you go long call. Now in this case we are looking at a 30 delta trades, means you are selling a 30 delta put, or in this case you are buying a 30 delta call. Now we'll compare these two strategies by looking at how many trades or what's the success rate of those trades and what's the average profit and loss. As you can see in the numbers, the short option strategy, means option selling strategy, has vastly outperformed the option buying strategy. From my average P&L, if we had just let the trades expire, took the trades all the way to expiration, the short put would have averaged $80 in profit, whereas the long call would have averaged only $8 in profit. If we had managed it really well, it would have averaged $55 in profit. In this case, just $5 in profit. Look at the difference. And it's a huge difference between the short put option and the long call option in terms of a average profit and loss. And we are talking about the longest bull run. Even in the longest bull run in the US history market, the short option strategy has far outperformed the long option strategy. Now we look at the other side of the coin, which is what if somebody was bearish on this stock? Yeah, I would pity those people who were bearish, because if you are bearish during this period, definitely it's a bad sign. You would have definitely lost money. But let's look at the short call and the long put, and see how they have compared to express the bearish sentiment. As you can see, in the short call, the loss is $8. The long put, the loss was $80. I understand both the strategies lost money because this was the longest bull run in the US history market, and if you are bearish on it, of course you're going to lose money. But being on the short side of the options, the loss is much lesser than if you were on the long option strategy. But if you really managed well, even in the longest bull run, even if you're bearish, you could have eked out some profit using the short option strategies, but not possible in case of a long option strategy. So in both the cases that we have seen, whether it is a bullish or is a bearish trade, in both cases, the short option strategies have vastly outperformed the long option strategies. So in the end, let's summarize all that we have learned in this session. The first thing, option sellers can win in 2 out of 3 scenarios of stock movement. If the stock does not move or move only a little bit in the reverse direction of your assumption, option sellers still win. Option selling is more forgiving and provides a margin of safety. Because of the initial premium taken in, you have that cushion. Third, looking at the impact of time, it is the best friend of option seller. It's the universal truth that time will pass. And as time passes, option sellers make money, option buyers lose money. Fourth, math favors option selling because the probability of profit is more than 50%. Whereas for option buyers, since they are already paid a premium, they're starting with the loss. Now first you have to cover up the losses, then only you can talk about profits for option buying. Lastly, volatility. We have seen that volatility is overstated in long term. Means the option sellers who collect premium that is more than the protection it provides are more profitable because the premium is overstated and the damage that happens is always less than the premium that was paid to cover the damage. So on a long term, option selling is a profitable strategy. So does that mean should we never buy options? No, I wouldn't say that. So there may be some specific cases where you may have to buy options. For example, you may want to contain the amount of buying power that is being reduced by a trade. So you would buy an option to manage your buying power effectively. Let's say if the implied volatility in the market is very low, at that time you may think of buying an option because then you're buying the volatility and you're hoping that implied volatility rises, the option prices will rise. So there are some scenarios in which you may end up buying options, but I think net being an option seller is more profitable in long term than being an option buyer. I hope this was useful for you. If you have any further questions, please write it in the comment section or you can email it to me at optiongig@gmail.com, and I'll be happy to respond to your questions. Thank you very much for your time.